We have yet to see a full implosion of the commercial real estate market, but that doesn't mean there aren't warning signs flashing out there. In today's video, we're going to look at the latest commercial real estate data and news and what to look for in the months to come. Let's get into it. Welcome to Real Estate Watch, the channel that focuses on forward-looking real estate analysis for the U.S. and regional markets. If you're new to the channel, my name is Eric and I am a professional economist in addition to being a licensed real estate agent, so I can bring you a unique perspective you'll be hard-pressed to find on other YouTube channels. We're looking at the commercial real estate market today, and what happens to it this year could be the biggest development for the U.S. economy and housing market, so we need to stay up to date on what's going on. There is a lot of commercial debt coming due this year, and with higher interest rates and falling commercial property values, especially for office properties, there is a big risk of a debt defaults that could trigger a banking crisis. A recent report from commercial real estate services firm CBRE said that there is nearly $2 trillion of commercial real estate debt coming due over the next 3 years, citing data from the Mortgage Bankers Association. That is by no means a small amount of debt and is something we need to take seriously given the high risk of defaults in our present situation. In my last update on the commercial market, I highlighted the asking rent for office properties as a key indicator to watch. This is because property valuations in commercial real estate are heavily tied to income potential. As of the first quarter of 2024, the average U.S. office asking rent is at a record high, according to CBRE, despite vacancy rates also at record highs. Office property owners are inclined to keep rents high, inflating the property value to secure favorable terms to refinance their loans. When office rents start falling, that could be a sign that the commercial real estate crash is starting or has already begun. The rent data from CBRE is quarterly, so we won't get a reading on where second quarter rents are for another month or two. But in distressed markets, we're already seeing this play out. In San Francisco's downtown financial district, for example, average asking rents are 1/3 lower than they were in 2020 after some buildings have traded at what is being described as fire sale prices. It remains to be seen how this will play out in other markets. We're still not seeing enough markets with lower rents to move the national numbers, but office rents are definitely worth keeping an eye on to assess if we are in the midst of the commercial collapse. Another indicator I'm looking at is the delinquency rate on commercial real estate loans. As of the first quarter of 2024, the delinquency rate for commercial real estate loans at commercial banks ticked up to 1.18%, the highest it's been since the second quarter of 2015, but still not high enough to indicate we're in the midst of a crash. New commercial real estate loans ticked down in the first half of June, but again, no big movements in the data and loans continue to be issued. So we're not in the middle of a crash at the national level, but the sheer magnitude of the debt coming due and the underperformance of office market fundamentals leaves little doubt there is trouble on the horizon. But this begs the question, can this be avoided altogether? The report by CBRE that I mentioned earlier seems to suggest that we might see the can kick down the road a bit and not face a disaster in 2024. They seem to think that a lot of the loans coming due this year will be extended to 2025 and beyond. But that could be just putting off the inevitable. There are two main factors affecting the office market right now that are the drivers of a potential crash: high vacancy rates and high interest rates. For vacancy rates, the work from home phenomenon and hybrid work arrangements are the main culprits, and those trends are not reversing course at this time. The percent of workers that are teleworking, the Bureau of Labor Statistics term for remote work, came in at 21.7 in May, up slightly from April. The drop in April was most likely due to seasonal issues in the data as opposed to a change in trend. We can see a similar drop in April of last year. As I mentioned in my last commercial real estate update video, this is a new data source from the Bureau of Labor Statistics, and you have to have at least 3 years worth of data before you can seasonally adjust it. But the overall trend is clear. More and more workers are working remotely, which doesn't bode well for future office vacancy rates. The other factor adversely affecting the office market is high interest rates, and we're not likely to see significant relief on that front in the near future either. In my last mortgage rate outlook video, I highlighted that we might only see 1/4 point rate cut from the Fed this year based on their updated economic projections and where Fed board members see the Fed funds rate ending up this year. A quarter rate cut isn't going to help out distressed commercial borrowers that much. They're still going to be in a tough situation. If they are able to kick the can down the road enough, they might be in a better situation. The median projection for the Fed funds rate was 4.1 for the end of 2025 and 3.1 for the end of 2026. But in the near term, commercial borrowers aren't going to see much relief on interest rates. There has been a lot of talk of an impending doom coming from the commercial real estate market leading up to this point, but we are now more than halfway through 2024 and it hasn't happened. You can see from all the data we looked at in this video that it hasn't happened yet. That doesn't mean that we're out of the woods. If vacancy rates and interest rates stay high and lenders aren't willing to extend existing loans, then a crash might be inevitable and we could be facing a default-fueled banking crisis with the potential to lead us into an economic recession, which would definitely be bad for the housing market. On the other hand, if vacancy rates stabilize, the Fed cuts rates, and lenders extend the loans, we might be able to escape that worst-case scenario. No one knows for sure what is going to happen. We need to monitor the situation as it unfolds. If you want to stay up to date on all the developments and what happens next, make sure you're subscribed to this channel to see my next update. I try to get an update on the commercial real estate market out once a month, so make sure you also hit that notification bell down below so you won't miss that or any of my other videos. And don't forget to hit the like button on the way out to support the channel and help it grow. Thanks for stopping by. I'll see you in the next video.